There are two different systems that can be used for recording inventory transactions, the periodic and perpetual inventory systems. Under a periodic inventory system, adjustments for purchases and sales of inventory are not made until the end of the period based on a physical count. Under a perpetual system, however, a continual record of inventory is maintained, and this is the method on which we will focus. We will record inventory purchases by debiting inventory and crediting cash or account payable. But let's examine the question, when will we record that entry? Consider goods that are shipped and are in transit. What if there's a problem during transit? What if the truck overturns and the inventory is destroyed? Who has the risk of loss? Said differently, who still owns the inventory? The answer is it depends. It depends on the contractual shipping terms when title transfers. Under terms FOB shipping point, title transfers when the seller ships the inventory. As the buyer, take title at the time it leaves the seller's warehouse, and in transit, risk of loss is with us. In contrast, under FOB destination, the seller retains ownership of the goods and bears the risk of loss during transport. We will not take title until it reaches the destination of our warehouse. What is the cost of inventory? We know it is the price of the good itself, but we also want to include any other costs necessary to get the inventory ready for sale. Shipping, for example. If we have to pay costs to transport the inventory to our warehouse, we must include that in the cost of our inventory. We would record freight charges by recording a debit or inventory account and credit to cash or account payable, depending on the method of payment. Notice that we're recording the cost of transportation directly to the inventory account. We are capitalizing all costs necessary to get the product ready for sale. When we do sell the inventory, we're going to record sales revenue at the selling price. We will debit accounts receivable or cash, depending on the method of payment, and we will credit our sales revenue at the selling price. We also need to record cost of goods sold and our reduction in inventory. The question is, how will we determine this cost of goods sold if it is not provided as part of the problem? Recall this relationship. Our beginning inventory, say 2, plus any purchases, maybe 5, including freight in, would give us 7 in costs available for sale. If we know our ending inventory, maybe 4, we can determine that our cost of goods sold is 3. If we understand this relationship, we can solve for our cost of goods sold. Let's look at an example. Circuit City has a balance in inventory of $2,500 at the beginning of June. The company uses a perpetual inventory system and has the following transactions. On June 2nd, purchase radios on account in the amount of $2,200. We will debit inventory for the purchase price paid, and we will credit accounts payable for the amount owed. On June 4th, when we pay freight charges related to that June 2nd purchase, we will make a debit directly to the inventory account, because the cost of shipping is a cost necessary to get that product ready for sale. We need to post each of these to our ledger account, giving us $4,850 of costs capitalized in inventory. On June 10th, when we pay for the June 2nd purchase, we will reduce our account payable and we will credit cash. Notice there is no entry to inventory here. Finally, on June 11th, when we sell the radios to customers, we will recognize our sales revenue. We will debit account receivable because it was made on account. The customer owes us $4,000, and we will credit sales revenue. Notice the cost of goods sold is not given as part of this transaction. We have a sale price of $4,000, and that's the revenue we recognize, but we're not told what our cost of goods sold is. But we can figure it out. If our ending inventory is $2,150, it must be the case we sold $2,700 in value. We need a credit to our inventory account in order to get the proper debit ending balance. We'll therefore debit cost of goods sold for $2,700 and reduce our inventory account by $2,700. Now let's look at the income statement presentation. Generally accepted accounting principles require that we use a multi-step income statement. The importance of this is that it highlights multiple components of net income. This provides more detailed information for users, enabling them to determine the profitability of the company's inventory transactions as well as other aspects of its business. Here's an example. Notice we begin with our net sales revenue, and from that subtract out our cost of goods sold, giving us this subtotal we call gross profit. From this subtotal, we subtract out operating expenses, so-called S, G, and A expenses. Selling general and administrative expenses include things like rent, insurance, wages, advertising. Subtracting out our selling general and administrative expenses gives us a subtotal called operating income. This is the aspect of our business that is recurring day after day, week after week, month after month, and financial statement users can expect to recur in future years. We then segregate out things that are a little bit unusual in nature, things that are not related to our normal day-to-day operations, to get our income before taxes, from which we finally subtract out income tax expense to get, bottom line, our net income. Make sure to retain an understanding of what gross profit is. This is a key profitability measure that financial statement users use to evaluate a company's performance. Understand that it's our net sales minus our cost of goods sold. Lastly, let's examine the lower of cost or market. Imagine that we have acquired items in inventory, but due to obsolescence based upon market innovations or other factors, our inventory value might fall. What are we required to do in this case? Generally accepted accounting principles require us to report our inventory at the lower cost or its market value. And in this context, by market value, we do not mean what we can sell it to the customer for. We mean its replacement value. The requirement to report at the lower of cost or market is an example of accounting conservatism. Here's a visual illustration. By cost, what we're referring to is the amount we've determined using FIFO, LIFO, or our weighted average method. Given that amount, we need to take into account what it would cost to replace the item. Not the value at which we would sell it, but the cost if we were to reacquire it. When we compare the two, we simply report it at the lower amount. Here's an example. Assume we acquired FundStation 2 at a cost of $300 and FundStation 3 at a cost of $400. In our inventory at the end of the period, using FIFO, LIFO, or weighted average, we have a balance of $12,500 before applying the lower of cost or market rule. If at the end of the period the market value for FundStation 2 is $200 and the market value for FundStation 3 $450, at what value should we report in our inventory on the balance sheet? We have FundStation 2, FundStation 3. FundStation 2 has a cost of $300. FundStation 3 has a cost $400. The market value for FundStation 2, its replacement cost, is now $200. The replacement cost for FundStation 3, $450. A simple comparison reveals that the lower of the two, in the case of FundStation 2, is the $200 market value. FundStation 3, however, the lower is its cost of $400. We will report it on the balance sheet at the lower of the two. We have 15 units, FundStation 2, thus we have $3,000 of inventory value. We have 20 units of the FundStation 3, thus we have $8,000 in inventory value. In total, 11. Notice that we do it on an item by item basis. We do not do it in aggregate. If before the lower of cost or market rule, our inventory ledger account had $12,500, but after applying the lower of cost or market rule, we find that we need to report only $11,000, notice that we have to make an adjustment. We have to write down the inventory by $1,500. This is an expense on the income statement. Here's another visual illustration of the process I just went through. Compare cost to market, choose the lower, multiply by the quantity to get the inventory balance on the balance sheet. In T account form, before adjustment, we had a cost value of $12,500. After applying LCM, we should report only $11,000. We must require an adjustment, an expense on the income statement, and a reduction in our inventory account.